An individual retirement account, or IRA, is a way to save for retirement and save on taxes as well. Designed primarily for self-employed people who don't have a company retirement plan like a 401k plan. There are two types of IRA, the traditional IRA and the Roth IRA. Though their goals are similar, traditional and Roth IRAs differ in some key ways. The traditional IRA allows you to contribute a portion of pre-tax dollars that reduces your taxable income for the year while setting aside the money for retirement. The taxes will be due as you withdraw the money. The Roth IRA allows you to contribute post-tax dollars. There are no immediate tax savings, but once you retire, the amount you paid in and the money it earns are tax-free. With the Roth IRA, you contribute after-tax dollars. Your money grows tax-free, and you can generally make tax and penalty-free withdrawals after the age of 59 and a half. With a traditional IRA, you contribute pre- or after-tax dollars. Your money grows tax-deferred, and withdrawals are taxed as current income after the age of 59 and a half. The key difference between Roth and traditional IRAs lies in the timing of their tax advantages. With traditional IRAs, you deduct contributions now and pay taxes on withdrawals later, while Roth IRAs allow you to pay taxes on contributions now and get tax-free withdrawals later. Traditional IRAs function like personalized pensions. In return for considerable tax breaks, they restrict and dictate access to funds. Roth IRAs function more like regular investment accounts, only with tax benefits. They have fewer restrictions but fewer breaks as well. Whether you think your annual income and tax bracket will be lower or higher in retirement is a key factor in determining which IRA to choose. Traditional IRAs. Traditional IRA contributions are tax deductible on both state and federal tax returns for the year you contribute. As a result, withdrawals, which are officially known as distributions, are taxed at your income tax rate when you make them, presumably in retirement. Contributions to traditional IRAs generally lower your taxable income in the contribution year. That lowers your adjusted gross income, or AGI, possibly helping you qualify for other tax incentives you wouldn't otherwise get, such as the child tax credit or the student loan interest deduction. If you withdraw money from a traditional IRA before the age of 59 and a half, you'll pay taxes and a 10% early withdrawal penalty. You can avoid the penalty but not the taxes. In some specialized circumstances, like when you use the money to pay for qualified first-time homebuyer expenses up to $10,000 or qualified higher education expenses, permanent disabilities and certain levels of unreimbursed medical expenses may also be exempt from the penalty, but you'll still pay taxes on the distribution. Roth IRAs. You don't get a tax deduction when you contribute to a Roth IRA. This means it doesn't lower your AGI that year, but your withdrawals from your Roth IRA during retirement are tax-free. That's because you paid the tax bill up front, so you don't owe anything on the back end. Roth IRAs have income eligibility restrictions. In 2022, singles must have a MAGI of less than $144,000, with contributions phasing out starting with a MAGI of $129,000. Married couples must have modified AGIs of less than $214,000 to contribute to Roth, and contributions phase out starting at $204,000. These limits increase for the 2023 tax year. The MAGI for single filers maxes out at $153,000 and begins to phase out at $138,000, while the MAGI range for married couples filing jointly is $218,000 to $228,000. Both IRAs carry no required minimum distributions, RMDs, which means you're not required to withdraw any money at any age or during your lifetime at all. This feature makes them ideal wealth transfer vehicles. Beneficiaries of Roth IRAs don't owe income tax on withdrawals either, though they are required to take distributions or else roll the account into an IRA of their own. Unlike a traditional IRA, you can withdraw sums equivalent to your Roth IRA contributions, penalty, and tax-free before the due date of your tax return, for any reason even before age of 59 and a half. You can own and fund both a Roth and a traditional IRA, assuming you're eligible for both, but your total deposits in all accounts must not exceed the overall IRA contribution limit for the tax year. Key differences. Both traditional and Roth IRAs provide generous tax breaks, but it's a matter of timing when you can claim them. Anyone with earned income can contribute to a traditional IRA. Whether the contribution is fully tax deductible depends on your income and whether you or your spouse, if you're married, are covered by an employer-sponsored retirement plan, such as a 401k. Another difference between traditional and Roth IRAs lies in withdrawals. With traditional IRAs, you have to start taking RMDs, which are mandatory, taxable withdrawals of a percentage of your funds, even if you don't need the money. At the age of 73 for account owners born between 1951 and 1959, and 75 for those born in 1960 or later. The IRS offers worksheets to calculate your annual RMD, which is based on your age and the size of your account. Pre-retirement withdrawals. If you withdraw money from a traditional IRA before the age of 59 and a half, you'll pay taxes and a 10% early withdrawal penalty. You can avoid the penalty but not all the taxes. In some specialized circumstances, if you use the money to pay for qualified first-time homebuyer expenses up to $10,000 or qualified higher education expenses. Permanent disabilities and certain levels of unreimbursed medical expenses may also be exempt from the penalty, but you'll still pay taxes on the distribution. In contrast, you can withdraw sums equivalent to your Roth IRA contributions penalty and tax-free during the tax year for any reason even before the age of 59 and a half. If you want to withdraw your earnings, different rules apply if you withdraw earnings, sums above the amount you contributed, from your Roth IRA. You would normally get dinged on those. If you want to withdraw earnings, you can avoid taxes and the 10% early withdrawal penalty if you've had the Roth IRA for at least 5 years. And at least one of these circumstances applies to you. You are at least 59 and a half years old, have a permanent disability, you die and the money is withdrawn by your beneficiary or estate. Use the money, up to a $10,000 lifetime maximum, for a first-time home purchase. Special considerations for Roth and traditional IRAs. A key consideration when deciding between a traditional and Roth IRA is how you think your future income, and by extension your income tax bracket, will compare to your current situation. In effect, you have to determine if the tax rate you pay on your Roth IRA contributions today will be higher or lower than the rate you'll pay on distributions from your traditional IRA later. Although conventional wisdom suggests that gross income declines in retirement, taxable income sometimes does not. Think about it. You'll be collecting and possibly owing taxes on Social Security benefits, and you may have income from investments. You might opt to do some consulting or freelance work, on which you'll have to pay self-employment tax. And when the kids are grown and you stop adding to the retirement nest egg, you lose some valuable tax deductions and tax credits. All this could leave you with higher taxable income even after you stop working full-time. In general, if you think you'll be in a higher tax bracket when you retire, a Roth IRA may be the better choice. You'll pay taxes now at a lower rate and then withdraw fund tax-free in retirement when you're in a higher tax bracket. If you expect to be in a lower tax bracket during retirement, a traditional IRA might make the most financial sense. You'll reap tax benefits today while you're in the higher bracket and pay taxes later on at a lower rate. You can contribute to a traditional IRA as well as a Roth IRA as long as you meet certain requirements. You can contribute only up to the maximum of $6,000 annual limit, $7,000 if you are 50 or older for 2022 across all IRAs. The limit increases to $6,500 in 2023 or $7,500 if you are older than 50. Is maxing out an IRA a good idea? Generally speaking, yes, even if you think the market is overpriced. It's generally worth making the maximum contributions to your IRAs. The tax savings you will make are likely to be far larger than the slightly inflated cost of stocks, shares, and funds. Should I choose a Roth or a traditional IRA? It depends. The key issue is whether your income tax rate will be greater or lesser than the tax when you begin withdrawing funds from the account. This is probably impossible to know for sure, so you are forced to make an educated guess. Factors to consider are your current tax rate and whether you think your tax rate will be far higher in the future. One way the two types of IRAs don't differ is in terms of administration. Most brokerages act as custodians for both Roth and traditional IRAs with the same minimums, fees, and terms for each. Give this video a thumbs up and be sure to subscribe.